Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 12th of May. I'm Daniel Lam, your host for the podcast. I'm always wary of those so-called one-way bet, because depending upon when you enter this quote-unquote bet, you may be susceptible to some counter-trend moves, or you may be getting in at the end of the trend. So this year, one of the most prominent asset classes that can be termed as such is the US dollar. The DXY index has dropped from close to 110 to a low at 98 last month. Now lately, it has been stabilizing and staged some mild rebound because of the de-escalation in the trade tensions. Should you be shorting US dollar at these levels? Well, it is always useful to be comparing across asset classes. So for example, S&P 500 had already recovered most of its losses since the escalation in trade tensions in early April, banking upon trade deals being made. Now, despite the fact that I head up equity strategy in the CIO team, I've always believed that FX is the more logical or rational asset class. In this case, the recovery in US dollar has clearly lagged those from equities because FX needs to see some hard evidence. Well, now we are getting that by the trade deal between US and UK at the end of last week. And this is leading to the perception that the EU and other G10 trading partners may accept similar deals, such as this 10% tariff like the UK did. Well, we may see some further recovery in the DXY to perhaps the 103 resistance level in the near term, but this is going to be some fluctuations ahead, especially the fact that the elephant in the room of the trade deals between US and China has yet to evolve. Well, therefore, rather than focusing upon US dollar pairs, crosses, i.e. currency pairs that bypass the US dollar, can offer attractive opportunities at this moment in time. So for example, we see opportunities for investors to be selling sterling yen. Now the relative policy divergence between the BOE and the BOJ will put further pressure on the pair. Now BOJ Governor Ueda has highlighted the potential downside risk to inflation stemming from US tariff actions, reinforcing expectations that the BOJ will be holding its rate steady for the rest of the year. Now, meanwhile, the BOE has cut interest rate by 25 basis points in line with market expectations, and the next cut is likely to be in September. The bank has revised its economic outlook, projecting that UK GDP will grow by 1% in 2025, up from an earlier estimate of 75 basis points, but growth in 2026 is expected to slow to 1.25% as global headwinds persist. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.